So most people think that if you buy an accounting firm or any business for that matter, I need to bring money to the closing table to get that deal done. And when we start talking about $1 million firm or something like that, most people are like, yeah, you must have $200,000, $300,000, $400,000 cash lying around that I need to pump into this acquisition. Well, first of all, we can do it for no money out of pocket. There's a lot of videos where I talk about others doing it for no money out of pocket and a ton of different ways that you can do that. But second of all, not only can you get it done for no money out of pocket, you can also get money at closing. And the crazy thing is you just have to ask. And as a thank you for liking, commenting, and subscribing on this video, here's a picture of a really cute capybara working hard on all those tax returns that people brought in like 3 days before October 15th. You gotta love them. But seriously, if you enjoy the content and you want it to pop up in front of you more, like, comment, subscribe, do something, and every time I put out a video, it'll probably pop up in your feed. So what if I told you that not only could you buy an accounting firm for no money out of your own pocket, but you can get money, and I'm talking about literal cash, wired to your account the day you close. I bought a $775,000 accounting firm, and the day we closed, I got a $77,500 wire to my account. And I'll talk about the difference between the $77,500 and what you're seeing a little later on. Okay, so you know that I'm obsessed with $0 down deals. I think that most people in our industry, whether you're an EA or a CPA or a tax pro or accountant, I think most people go about it the wrong way. They want to build one client at a time. And if that's your flavor and your preference, nothing wrong with that. But I can tell you now, it's probably a 7 to 10 year plan for you to get pretty solid cash flow with a team in place where you're not bogged down 60, 70 hours every single week. Meanwhile, those that are actually doing acquisitions, look at Patrick here. Him and his partner Russ just got an LOI a few days ago. Those that are doing acquisitions are not only getting it done for no money out of their own pocket, they're getting paid at closing as well. And what I'm talking about is something called working capital. Now, I didn't know much about any of this, and I'm really thankful that the lender actually came over to me and said, hey, by the way, if you want a little cash flow in the bank account as you're getting things off the ground, we can roll that into the loan for you. And I was like, what did you just say? I said, are you telling me that not only am I doing this deal for no money out of my own pocket, you can pay me on the day we close? He's like, yeah, it's called working capital. You just have to justify it. And at first I was thinking, okay, well, that'd be great if I could get $10,000 or $20,000. Then I realized 10% of your deal is a standard, a single base hit. You can get that all day. And the reason I wanted to talk to you guys about working capital is because this is something that most people get wrong. They think only about the money that they have to deposit the day they close or put as a down payment the day they close. And they completely forget about all the things that need to happen after you acquire a firm. The seller is not going to be paying for your tax software and subscriptions anymore. They're not going to be paying the rent. They're not going to be paying for the payroll. They're not going to be doing any of those things. Yes, it's great if you can get a deal done. And I've done a couple of these 100% seller financing deals. Those are awesome. But what most people forget is, wait a minute, what about that first month where I have $25,000, $30,000 in expenses and the cash flow in the bank only shows 10 grand. I got a deficit here that I need to cover. And the question you need to ask yourself is the bank going to cover that for me via the SBA and working capital? Or am I going to have to come out of pocket myself to fund that difference? See, I think we're all mostly like accrual minded. And we all think that, okay, over the course of a year, if my firm makes $700,000 and my expenses are half of that, I should be good. But especially in our industry, we're very cyclical, we're very seasonal. There are times where cash flow and revenue may not be coming in, yet those expenses don't change. I mean, I would almost go as far as to say working capital can be a lifesaver for you when you're starting off. It's always great to have some money in the bank for these situations where there's a bit of a lull in the revenue. Honestly and truly, the SBA is there to make sure that your deal will succeed. And there are things that they set up, like the debt service coverage ratio has to be at a certain point to make sure it even profits. And they also offer the working capital because they know the realities of running a firm are such that every now and then you might need some cash reserves to dip into to make sure that the operation can still survive. They are truly there to make sure that you're set up for success. And I'm grateful that they do offer something like that, because most people, again, do not think about the working capital. And if they do, they're probably underestimating how much they need. Now, I want to be clear, this is not free money. This is rolled into the loan. But something I would really argue with people is, think about this. Let's say you didn't take any working capital the day you close. Well, if you run into some cash flow issues and now you're scrambling saying, uh-oh, I need 20K, 30K. Look, if you got it in the bank account, in your own bank account, and you can just inject it into the firm, great, more power to you. But you know I'm a $0 down guy, and I want these businesses to run without a penny out of my own pocket. When you go out there and you start looking for financing options to get $20,000, $30,000, you're going to find that most repayment periods tend to be anywhere from 12 to 36 months. Maybe you can get 48 months. It's still very high interest, and you're going to have a much shorter repayment period, which means now your debt service is much higher. Grabbing that working capital as much as you can, even if you're like, I probably don't need much of it right now. It's one of the most favorable loan products out there that you can use to grab cash. You're going to get to pay that thing back over at least 10 years over, I think the interest rates right now for the SBA are like at 10%. 10 years, 10% to pay back the $20, $30, $40, $50,000, $100,000, whatever it may be that you get in working capital. I'm telling you right now, it's going to be very hard to find something comparable to that in the open market for straight up liquidity purposes. This is your window, your opportunity to get some working capital in the bank. Even if you feel like you don't need it, I would still recommend you get it and just pay it over the 10 years. And I'll give you guys a perfect example of working capital and how cash flow needs can come back and bite you in the butt. That $775,000 deal I didn't realize this up front. And look, you don't know what you don't know. Maybe looking back, I should have realized this. I didn't realize that the bookkeeping component of the firm was on a 2-month lag. And so the day I owned this firm, I was thinking, hey, within the next 30 days, all of this cash flow is going to be coming in. Well, no, it was actually 2 months. And then there were, with the closing and everything, there were other delays in the process. And so it was almost 3 months before I was able to start collecting on a lot of the revenue that I thought was going to be there. Well, guess what? I bought that firm in September. The spike of revenue kind of dissipated after October 15th. And now I got November slow, December slow, January, it's just starting to pick up on the tail end of January. It was a long period of time where I was missing a good chunk of bookkeeping revenue because of how the way they did collections. I have since fixed that, but this is a great example to show you how the cash flow that's needed for the firm on an accrual basis looked fine. But when you're on a cash basis, cash flow focused, I was like, uh-oh, there's $40,000, $50,000 in kind of a deficit over that period of time that I'm dealing with, that I'm faced with. I was really thankful that we had that $77,500 wired to us from the SBA, because that resulted in me being able to continue to run operations, make sure people are getting paid, make sure the bills are getting paid, all of those different things, so that I could get to tax season where a bulk of the revenue was about to come in. Now, the rules of working capital are such that the lender is always going to say, you're going to need to justify why you need these funds. Again, 10% is very standard in the industry, but we were just talking about how our industry is very seasonal, very cyclical. So it's actually even easier for us to explain why we need to justify why we need that working capital. Now, I have seen deals and I've been a part of deals where we've been able to get 18, 19% working capital. Above 10%, it's the same rule. You better be ready to justify why you need it. Now, if you're like, look, even if I could just get 10% working capital, I'd be doing great. You shouldn't have a very hard time in our industry to justify why you need the working capital. It's really going to come down to saying, hey, tax season is the bulk of the revenue. We're sitting here in, November. I need to have working capital to make sure that I can continue the operations. So I know it sounds crazy and it sounds like, wait a minute, what? But I'm telling you, as crazy as it sounds, the day I closed, I had the down payment from my investors. I wired that over to the SBA, and then the SBA wired me the $77,500 in working capital. Now, I told you I was going to show you the screenshot again and explain the difference. There was some earnest money deposit refund, and then I think there was some closing costs estimations that were kind of in our favor. I think got overestimated at first. So that's the difference between what you're seeing and the $77,500. But the point is that look at the money that I have on day one. You are really setting yourself up for success if you can get a hold and access to this working capital. It's another reason why I love the SBA. It's another reason why I think if you use it smartly and wisely, it can be a really big lifesaver for you. And one thing I do want to note on the working capital, I said it already, but it does get rolled into your loan. So when you're calculating your debt service coverage ratio, you should be at 1.5 or higher on your DSCR. However, once you roll in that working capital, there will be an unfavorable hit to your DSCR because it's more financing. So just be mindful of that. If you're floating at 1.5 and you haven't factored in working capital yet, you're skating on thin ice there. It's better if you're at 1.6789, and from there you can add working capital, and now you have a cushion that you'll be able to get and stay ahead of. And listen, I want you to understand what the trend is. The AI CPA has a stat that says 3 out of every 4 firm owners are at or above retirement age. The baby boomer wave, it's not something that will come in the future. It's here right now. I've acquired 5 blocks up to this point, about 2,500 clients. Those all came from people that were 65 and above, all looking to retire. The data is right in front of you. All you need to do is figure out how to capitalize on the opportunity. If you're interested on learning more about taking advantage of this, comment 5 down below and I'll send you 5 different ways that you can acquire an accounting firm for no money out of your own pocket. And to set yourself up for success, if you're interested, I do also offer buy-side advisory. One thing I have found in being in the market in the industry is there is a significant deficiency when it comes to buy-side advisory. All those brokers out there, make no mistake about it, they're on the seller side, and if they can take advantage of you and squeeze you, I promise you they will. And look, they don't owe you any loyalty. They're representing the seller. I also offer a community full of other CPAs and EAs and accountants that are out there doing deals. I showed you Patrick earlier. Here's Matt, who I'm really proud of this guy. He had to go back and renegotiate a seller note. I think it was a 5-year seller note, and he had to negotiate it to a 10-year seller note. We helped him through all of that, helped him navigate that conversation. And as you can see, the seller didn't even bat an eye. But listen, it's not all sunshine and rainbows. those. The reality is, if you don't set this up correctly, you could lose a lot of money on the front end, or on the back end, half of your clients can disappear on you. With my advisory, with my community resources and templates and all these other things, that won't be you. This isn't a get rich quick thing. There's a process to follow, but if you follow it like all these other members are, you're going to be just fine and you're going to acquire a block. There's a link in the description below. You can book a call with me. We'll talk a little bit more about your individual situation and how my advisory services and resources can help you out. I hope the concept of working capital is really sinking in for you. Look, if you have access to other working capital, that's fine. But when you acquire a firm, it is very important that you have something in reserves to make sure that you can push the operations forward in the event that there is a lull in revenue. And in this industry, that is something that we have to consider and address. And remember, it's a cruel world, but we're better together. We'll see you later.
It's a rare condition this day and age to read any good news on the newspaper page. And love and tradition of the grand design, some people say.